Before we jump in, I do earn a referral fee when you use the services and companies I demonstrate in the video, but there is no additional cost to you. I chose them because they're the best in the industry and you're safe with them.
Welcome, investors and real estate enthusiasts. Today, we delve into the exciting world of rental tax deductions and strategies. This is a topic that, while often overlooked, holds immense potential for maximizing your return on investment in the real estate sector. Ensuring that you're well-versed in the ins and outs of rental tax deductions and strategies can be the key to unlocking significant savings and profits. We're talking about the potential to turn a good investment into a great one simply by understanding and applying the principles of tax law. While it may sound dry, the truth is that rental tax deductions and strategies can be like a treasure map, leading you to hidden wealth in your real estate investments. If you're involved in the world of real estate investing, this is one area you can't afford to ignore. Stay tuned as we unpack the complexities of rental tax deductions and strategies. First, let's clarify what rental tax deductions are. In the world of real estate investment, rental tax deductions can be a game changer. They are essentially expenses related to your rental property that you can subtract from your taxable income, thus reducing the amount of tax you owe. Understanding what qualifies as a rental tax deduction can be a little tricky, but don't worry, we're here to break it down for you. First up, we have mortgage interest. If you've taken out a loan to purchase your rental property, the interest you pay on that loan can be deducted. This can be a significant deduction, especially in the early years of a mortgage when the bulk of your payments are going towards interest. Next, we have property tax. This is the tax you pay to your local government based on the assessed value of your property. This is another substantial deduction that can really add up over the year. Another category of rental tax deductions is operating expenses. These are the day-to-day costs of running your rental property. Think about things like advertising, insurance, utilities, property management fees, and even travel costs related to your rental activity. Depreciation is another key deduction. While the value of the land your property sits on does not depreciate, the building itself does. Each year, a portion of the cost of the building can be deducted as a depreciation expense. Lastly, we have repairs. Any necessary fixes to keep your property in good working condition can be deducted. However, it's important to differentiate between repairs and improvements, as improvements must be depreciated over time, while repairs can be deducted in full in the year they are made. So, to recap, rental tax deductions include mortgage interest, property tax, operating expenses, depreciation, and repairs. These deductions can greatly reduce your taxable income, potentially saving you a significant amount in taxes. Now that we have a grasp on rental tax deductions, let's move on to the strategies to maximize these deductions. Implementing suitable rental tax strategies can significantly impact your investment returns. Let's delve into some of these strategies that can help you optimize your rental income. Firstly, maintaining good records is crucial. This doesn't just mean keeping a file of your receipts, but also documenting all your income and expenses related to the rental property. A well-maintained record can provide a clear picture of your financial situation and help you claim all the deductions you're entitled to. Next, separating personal and business expenses is a must. Using a dedicated business account for all your rental activities can make tax time a lot less stressful. It provides a clear division between your personal and business finances and makes it easier to track your rental property expenses. Now, let's talk about hiring a professional for tax matters. The complexity of tax laws can be overwhelming. Therefore, seeking the help of a tax professional can be a wise decision. They can help you navigate the murky waters of tax laws and ensure you're not missing out on any potential tax benefits. Lastly, staying updated with tax laws is imperative. Tax laws are constantly changing, and being unaware of these updates can cost you. By staying informed, you can take advantage of new tax deductions and avoid penalties. Implementing these strategies can help you maximize your rental income and minimize your tax liabilities. However, they're just a part of the bigger picture. It's about understanding the system and using it to your advantage. It's about finding the right balance between your income and expenses. And it's about making informed decisions that can positively impact your bottom line. While these strategies are beneficial, there's a loophole that can further optimize your rental tax situation. Navigating tax loopholes can be tricky, but it's worth it when it comes to the rental tax loophole. Let's dive into what this loophole is and how it could potentially benefit you as an investor. The rental tax loophole is a facet of the tax code that allows investors to qualify their rental property as a business rather than just a passive investment. This classification comes with a slew of benefits, the most attractive of which is the opportunity for more tax deductions. Now you might be wondering, how does one go about qualifying their rental property as a business? Well, the answer is a little complex, but stay with me. The Internal Revenue Service, or IRS, states that a real estate professional must spend at least 750 hours per year managing their properties. That's roughly 15 hours per week. Moreover, this time must represent more than half of the professional's working hours in a year. With this qualification, your rental property transforms from a passive investment to an active business enterprise. This shift in classification opens the door to a world of potential tax benefits. You can deduct business-related expenses like advertising, office supplies, and even travel costs related to property management. Furthermore, you can take advantage of depreciation, which allows you to write off the cost of your property over a set number of years. This is where the rental tax loophole truly shines. By maximizing these deductions, you can significantly reduce your taxable income. And the lower your taxable income, the less you owe when tax time rolls around. However, it's essential to remember that, like any tax strategy, the rental tax loophole isn't one size fits all. It requires careful planning and meticulous record-keeping to ensure you meet the IRS's stringent requirements. And of course, it's always wise to consult with a tax professional to understand how this strategy could fit into your broader financial plan. This loophole, though complex, can offer substantial tax savings for savvy investors. So keep an open mind, do your homework, and you could potentially unlock significant financial benefits. While exploring rental tax deductions and strategies, it's crucial to be aware of potential pitfalls. Now let's talk about some common mistakes and how to sidestep them. First up, the mixing of personal and business expenses. This is a common blunder that could lead to a tax audit nightmare. It's easy to think, I'll just buy this new couch for my rental property and write it off. But if you're also using it for personal use, you're crossing into murky waters. To avoid this, maintain separate bank accounts for your personal and business transactions. This will help keep your expenses crystal clear and audit-proof. Next comes the pitfall of not keeping accurate records. You might think you'll remember that repair expense from 6 months ago, but trust me, you won't. And neither will the IRS if you can't provide documentation. The solution? Keep detailed records of every single expense related to your rental property. Be meticulous. Save receipts, invoices, contracts, and bank statements. Implement a reliable system for record keeping, whether it's a software or a good old-fashioned filing cabinet. Your future self, and potentially your accountant, will thank you. Lastly, let's tackle the misunderstanding of tax laws. Tax laws are complex, and they change frequently. Misunderstanding or not staying up to date with these laws can lead to costly errors. For example, you might not realize that you can't claim a deduction for improvements in the same way as repairs. To avoid this pitfall, consider hiring a tax professional. They can guide you through the labyrinth of tax laws, ensure you're compliant, and help you take advantage of all the deductions and strategies available to you. Steering clear of these pitfalls can ensure you're maximizing your rental tax deductions and strategies. Remember, a savvy real estate investor is not just about spotting the best opportunities, but also about navigating around the potential pitfalls. As we conclude, let's recap the crucial points we've discussed today. We dove into the intricacies of rental tax deductions, highlighting the importance of understanding and utilizing these deductions in your real estate investments. We then explored various rental tax strategies, emphasizing the role they play in optimizing your return on investment. Our journey led us to the rental tax loophole, a unique opportunity that savvy investors can leverage to significantly decrease their tax liabilities. However, we also underscored potential pitfalls and how to sidestep them, reminding everyone that while these strategies can be highly beneficial, they must be applied judiciously to avoid undue complications. In essence, the world of rental tax deductions and strategies is complex, yet ripe with opportunities for those willing to learn and adapt. Armed with this knowledge, you're now better equipped to navigate this complex world. Thanks for joining us, and we look forward to seeing you in our next video.